You can backtest dozens of strategies. They will look incredible on paper, and then the moment you run them in the real world, the results are a complete 180 from everything that you expected. And not only have you lost money on something you were so sure would be great, you've also just wasted hours and hours of your life. Now, I know that feeling better than anyone else. I had a team of 2 full-time backtesting analysts. Combined, they ran over 100,000 backtests. I spent tens of thousands of dollars and more than I want to count. And in many cases, I was still left with strategies that fell completely apart the moment they hit the real market. So after going through all of that, here's what I found actually works. Now, for those of you who do not know me, my name is Stephen Brooks. I am a hedge fund manager, and I generate cash flow for myself using systematic option strategies, mostly on the S&P 500 index. And what I'm about to talk you through in the next few minutes is going to save you an enormous amount of time and protect you from the loop that destroys most market participants. Backtest looks great. Run it live. Results are nothing like what you expected. Then rinse and repeat. Now, here's the thing about backtesting. It's a double-edged sword. On one hand, it's the only tool we have. The only way to have any real confidence about what might happen in the future is to study and base decisions on what has already happened. There's really no substitute for that. But the problem is that most people are not looking at the data the right way. And then they are completely surprised when their live results deviate dramatically or far worse than what the backtest showed them. So let me give you 4 things that, in my experience, running over 100,000 backtests actually determine whether a strategy is going to hold up in the real world or fall apart the moment you turn it on. Now, the first thing, and this is where so many people are completely wrong and get started on the wrong foot before they open up a spreadsheet or before they go ahead and start using some of the backtesting software websites that are available today, is that you need to start with an edge that is already embedded in the market. Not something you are trying to manufacture, not something you are trying to create, not something you are hoping is there, something that is already embedded in the market. Now, here's a test that you can run. Can you explain that edge to someone who knows nothing about markets in 1 or 2 sentences and have that person understand it? If you can't, I promise you, it is not an edge already embedded in the market. Now, here's a very simple example of a real edge already embedded in the market. At 325 each day, the circuit breakers that protect the market against catastrophic losses are turned off. That means anyone willing to take on risk from 325 to 4 needs to get compensated extra for doing that. That is an edge. The market created it. I didn't. Now compare that to, the stock is above the Ichimoku cloud, it's below the 70 RSI, and the 2-period moving average has just crossed above the 10-period average. Nobody can explain why that works, because it doesn't. That is not an edge. That is a pattern that someone curve fitted to historical data and has, in my experience, 0 chance of being successful in the live market. You need to start with a real edge that is embedded in the market, or quite frankly, you should not be risking your own capital. Now, before you think about things like entry timing, exit logic, or the type of trade you might be doing, you need to know your exact real world costs. What are your actual commissions? What is your real entry slippage? Meaning, what do you actually have to pay above mid price to get filled? What does it cost you to exit? How much slippage do you have on stop losses? If you don't know these numbers exactly, you are not backtesting. You are writing a fictional novel. Now, here's what I recommend. Take a screenshot or take these statements of your last 6 months from your broker. Upload those to ChatGPT and have it tell you what the real average slippage and commissions are for you per trade. Then hardcore or hard code those exact numbers into every single backtest you run going forward. Because here's the truth. If your costs are off by even a few dollars per trade, that error will compound into tens of thousands of dollars of deviation between your backtest and the live results. Get those costs right. Now, once you have a real edge and real costs, you need to think in terms of frequency. And to tell you the truth, I've probably never actually seen anyone else really get this right. A strategy that fires one time a week may have beautiful numbers, but there is not enough statistical significance in that sample size to trust that those results will continue into the future. Even though you may have tested it over many market years, length of time is not equal to statistical significance. A strategy that fires 10 times a day gives you a data set that you could actually have confidence in. Not because you've run it over more market years, but because that level of occurrences is more likely to be trustworthy. More occurrences means more certainty, not more time. It means the edge has been tested across more occurrences. And the more frequently it happens, the more you can actually have confidence in the data that you are looking at. Now, this is the one that separates real strategies from curve-fitted ones. Your strategy should have at most one filter for entry. One. That might be a VIX level. That might be a time of day. That might be a directional move from the open. But you get one filter. The moment you start stacking filters, this moving average and this VIX level, and I only do it on Wednesdays and Thursdays and only when the prior day closed green. You are no longer looking to collect an edge that is embedded in the market. You are trying to manufacture one, and manufactured edges do not work in the real world. The strategy with the most absurdly impressive backtests are almost always the ones with 5 filters, complex exit logic, and trailing stops that are adjusted 3 times throughout the trading day. They look like home runs, but they are not. They are simply over-optimized to historical data, and they will never get positive results into the future. What you actually want, though, is a single. We just want you to get on base. A strategy that is simple, explainable, has real costs baked in, trades frequently enough to trust, and has one filter or none. That is a strategy you can actually run in the real world. And when you have a few singles in a portfolio, then the portfolio becomes a home run. So that is what my team has built. That is what I trade every day. So if you are an accredited investor and want to invest in our fund, there will be a link below this video where you can learn more about that fund. In our fund, we run multiple different strategies that we have found following the same logic I spoke about in this video. Or if you are interested in learning from us, utilizing strategies that check all these boxes and have our software handle the day-to-day for you, there will be a link below this video as well. And I'll see you in the next one.